Welcome to Sectors Up Close. I'm Elena Casas. Today we're looking at technology and my guest is Anthi Tsouvali, multi-asset strategist at State Street Global Markets. Semiconductors are seizing this week's tech headlines as UK-based chip designer Arm prepares to go public in New York in the IPO of the year. That initial public offering will be priced between $47 and $51 a share, according to an updated filing on Tuesday, valuing the company at up to $52 billion. And its key customers, including Apple, Google, Nvidia, Samsung and Intel, have all indicated they will be investing at the IPO price. But some fund managers have expressed scepticism, saying Arm has missed the boat on AI and its revenues are flatlining. Across the semiconductor space, excitement around artificial intelligence has pushed stocks up this year. The Philadelphia Semiconductor Index is more than 45% up year to date, after a massive leap in Nvidia in particular. Well, to talk about those valuations and the wider sector, I'm joined now by Anthi Tsouvali, multi-asset strategist at State Street Global Markets.
Hello.
Anthi, thanks so much for joining us. What does this huge IPO from Arm tell us about the health of the wider sector?
Yeah, so it's going to be very interesting to see the demand that the IPO will get. It's, of course, a very much talked about IPO. It's expected to have high valuations, and probably it's going to go very well. So it's going to be very interesting to gauge the demand from investors in a sector that, as you mentioned, is already doing very well this year.
You did say in a note, though, that semiconductors are broadly still undervalued. We know they've been suffering with oversupply this year after supply dried up during the pandemic, and then they put on extra production, which hasn't quite seen enough demand this year. But are they turning the corner?
I think you're very right. It's actually 2023 so far has not been very good for semiconductors in terms of demand. We're seeing that revenues are going down. There's a lot of geopolitical challenges, but numbers now are becoming more positive. And it seems like we're heading towards the trough on the second half of the year with a very sharp turnaround in 2023. So in general, valuations are high. We're not going to say that semiconductors are cheap, but we think those are justified, and that's because the sector has a very good profitability. As we're saying, demand is still there, and what we have seen historically is demand for semis is immune to recession or the wider economic backdrop, and so that's why we're still positive. And I think that one thing that is very interesting is that what we're seeing in our database is that positions are still undervalued. So institutional investors still don't hold high positions in semis, but they're still buying. So that could be very positive for semis.
A lot of this is being driven by excitement about AI, isn't it? But that's going to play out quite unequally across the sector, isn't it?
It is, yeah. It's not going to be the same for all, and that's why some people are talking about ARM in the sense that it's not going to benefit from the AI frenzy that we've seen this year. What we're noticing is that within semis, it's going to be more the companies that have access to or do business with cloud or with data centers that are going to be benefited the most. And probably we've already actually started seeing capital getting deployed and being spent there. So we should see the impact on the bottom line probably as soon as early next year. And then eventually the hope is that we're going to see the AI getting more into the mainstream products like PCs or smartphones, and that will take a little bit more time. However, what is interesting is that those devices will actually need more power, more memory, so chips need to be upgraded in order to be able to support AI. So that's another advantage for semi companies.
In an uncertain economic environment, has tech gone from being a growth sector to simply the safest bet investors can make?
Yes, and I think that it's very interesting how things turned between last year when tech sector was penalized and it was just seen as a long duration asset that in a high interest rate environment won't do well. Things actually changed this year when investors and markets start focusing less on the macro environment, realizing that earnings and growth have been steady, companies have much better profitability, stronger free cash flow generation, and actually we're seeing that those companies are cash rich, so they can withstand shocks better than any other sector. So now I think tech is more of an all-weather company that can do well if things turn to the worse.
Anthi Tsouvali of State Street Global Markets, thank you so much for joining us.
Thank you.
And that's your roundup of the tech sector. I'm Elena Casas, and this is Reuters.